Welcome to the Decentralized Future podcast. Today we have a special guest, Steve Streetman, with us. And Steve, welcome to the show.
Thanks for having me.
It's a pleasure to have you, Steve.
Yep, great to have you on the podcast. Steve and I know each other from our startups.com group. You are our second guest on the startups.com group. It will be a fun ride to have. We have amazing topics, how blockchain technology shaped the real estate industry and like such a traditional business. We know real estate as like traditional investments plans and so on, but like how it will change with the emerging cryptocurrencies and blockchain technology. We'll talk about all of that. So if you want to like go in with just this like small introduction about yourself, that would be great.
Sure. So my name is Steve Streetman. Sort of started my career actually in cryptanalysis, breaking codes and ciphers. And so I've been always very interested in it, especially in public key cryptography and how all that works. I've been a data scientist for much of my career, doing sensor integration and modeling and various types of computer modeling and pretty cool projects that I've had a chance to work on over the years. I also became a real estate investor back in about 2004. And so I found cryptocurrency as a way to combine the two, really, because cryptocurrency has obviously cryptography behind it, but it's a new kind of asset class with amazing appreciation. But real estate has a lot of cash flow, which you don't usually get well from cryptocurrency. It's got tax advantages, and there's really good ways to leverage to get into real estate. You can get mortgages for most of the purchase price. And so having the advantages of real estate and cryptocurrency together, I ended up getting into cryptocurrency by trading land for it directly, not selling the crypto and buying the land, but actually a direct trade, and became really interested in all the different ways that real estate and cryptocurrency interact. And when I looked out and was talking with people, everybody was focused on one little niche. I mean, somebody cared about property tokenization. Another person was looking at title. Another person was doing trades with real estate and cryptocurrency. And I went and took a broad brush across all of those and wrote the book that introduced me to you guys, Cryptocurrency and Real Estate. And that's kind of how I got here. I guess there's one more thing in the middle there. And that's around 2011, I got involved in a niche in real estate called real estate exchange. And there are groups in the US and actually internationally who trade properties. So for example, I might give you my free and clear house and a note for $300,000 and you'll give me your fourplex. Okay, so you're actually doing asset for asset trades. They become very, very creative deal makers in real estate. And that was a perfect fit with cryptocurrency, because cryptocurrency really is an asset more than a currency. It's viewed as an asset, as something that you own. And so the principles that are involved in real estate exchange work really, really well by adding cryptocurrency into the mix.
You mentioned about lots of amazing stuff in like direct trade and real estate exchanges. I seen that on the book, this barter currency. You change an asset to assets or like your work. That's called barter. I never heard this before, like especially on this crypto currencies. I was fascinated with the like when I read that. But if you want, like we can go with that and like elaborate more on that, how this barter currency works.
So the vast majority of cryptocurrencies are designed to be traded on a cryptocurrency exchange. Mm-hmm. That's really about the only thing you can do with them is trade them on a cryptocurrency exchange. Now you might trade them for fiat, you might trade them with insurance, you might stake them. There might be some other things that have evolved over time. But there was, before cryptocurrency, this idea of barter currency. And so people would set up their own script. And they would have a group of people who would agree to take that script. And so a lawyer might donate 100 hours and he would get a certain amount of script, and a plumber might donate 100 hours and they might get so much as well. and they could trade the scripts for services. So it was a way of doing that without going through standard money, which has all kinds of issues. The US dollar is depreciating probably like 15% this year due to inflation. And other currencies are also printing way too much currency with no real reins on that. And so the purchasing power of currency goes way down, but the purchasing power of script that's based on a certain number of hours really doesn't. So this idea of barter currency has been around forever. The largest one in the world is probably ITEX, the International Trade Exchange. And what the guys who launched one of the cryptocurrencies that I've been interested in, called Troptions, TROPTIONS, standing for trade options. They thought, well, let's have a cryptocurrency that you just use to trade for stuff. So you're not trading on an exchange, you're trading directly for things. And that's a really interesting concept, but it's really hard to execute. Because everybody who knows cryptocurrency knows, okay, which exchange is it on? Where do I go to buy it? With dollars or with Bitcoin or with some other trading pair. And the people who have stuff don't know cryptocurrency. So you're really having to build a huge bridge between two separate worlds to make it all work. And I'll have to say that the execution on the tokens hasn't been as strong or as well backed as you would hope. And so rather than this, onslaught of, hey, this is huge and it's coming out right away, it's been this slow buildup over time of more and more people getting involved. And so value has been fabulous on the barter tokens. I think that if you actually look at the listings on xchain.io or wherever you go, the value is, I don't even want to say how many percents it is because it's a number that is just ridiculous. But the liquidity has been a challenge because you don't have that many people using it. But as the number of people using it increases, that liquidity becomes real, and then the tokens become real. And there's 2 or 3 different approaches to the barter currency. The Troptions is one. Another one is called RexNet, which stands for Real Estate Exchange Network. And they were putting together a network of coins, some of them geographically focused, some of them industry focused, and then the top coin was RexNet itself. And they also have had some rollout issues, and they need to do a better job of getting a site where you can actually do the barter. I think of it like an eBay, only denominated in cryptocurrencies. And if that site existed, I think that would be very, very popular, and that would be a huge winner for these currencies.
And how these currencies, Steve, actually are valued? Like, are they based on one-to-one assets? Are they backed by them? How is the valuation actually works for these barter currencies?
So the barter currencies are not backed by assets, and that is it's an issue and an advantage, right? It's an advantage because if they were backed by assets, they would certainly be securities in the U.S. Because they're not backed by assets, they're not really utility tokens. They're more like a currency money type of token. But that means then that you have to have acceptable use in order for them to become valuable. And that's why you need a number of people accepting them for it to go up. You need payment rails. You need all the sorts of other things that you need for crypto to make them work better. I'm glad you're interested in that one. So I found that one fascinating. There are some sites where people can put up items and trade directly for cryptocurrencies. And I'm blanking on the website, but I'd be happy to send you guys a link to put in your notes for the podcast.
Yeah, and also there are some sites in your book as well. By the way, Doc loves being mysterious. That's why he mentions the book. But I think we should be more specific about it, which book you wrote, because for those who don't know, Steve is the author of this amazing book, Cryptocurrency and Real Estate. It's really brilliant. We both read it before the program, and that's where the questions basically come from for your information. Totally recommend it.
How to profit as Bitcoin and blockchain revolutionize real estate investing. It's Great topic. I want to like understand better the dynamics. I understand that you can possibly like trade any service, any product as a barter, right? Let's say we want to invest in multiple units estate, and so it would have many investors, or at least a couple of investors, and some services, property management maybe. So I see directly that like property management can be used as barter in this case. Does it go with tokens? How is the relationship of like barter currencies and like tokens and like this token economics?
Sure. Well, the token economics look probably more like Bitcoin, where you need to make sure the supply or the distribution is limited and appropriate. Utility tokens also have a place in real estate, but it's a very different kind of place. So you mentioned property management companies. If let's say you have a student housing complex, so you're housing students who are young and they're all into crypto already. Well, there's a lot of services that go along with the student housing business. So you might have washers and dryers, either coin operated or some other how they're operated in your facility, or you might have them available for your particular apartments as an upcharge. You might have valet trash. You might be able to reserve the clubhouse. You might be able to do other kinds of things in that apartment complex. If you were to issue a utility token, a cryptocurrency to your residents that can really only be used at your apartment complex, they get benefits from those cryptocurrencies that they wouldn't get anywhere else. And so you intend to increase the loyalty. It's sort of like having frequent flyer miles for an airplane, right? Which is I don't know why the airlines aren't already moving frequent flyer miles to the blockchain, but I think they should.
1 year.
Yes.
Like just 1 year.
Yeah, I believe you. It makes perfect sense. The only downside to the airlines is that once it's on a blockchain, the ownership is more immutable. And so people might be able to sell them or trade them. And so people could go buy the frequent flyer miles instead of actually buying the flights and getting them issued. So that may be the downside to them. But for an apartment complex, you get additional loyalty, just like an airline gets additional loyalty from people who build up frequent flyer miles. And you could even do it as a savings program. Let's suppose that you've got a family and your dad went to the school and he knows that he wants to have you go to the school. In the US, in some places, that family will put money aside in a specific program to pay for tuition at that specific school. Why wouldn't they put money aside to get you into the best apartment complex on that school and have a savings program? They would buy the utility tokens in advance. They could then use them for rent. So, they essentially invest in that apartment complex in advance. The property owner gets money well in advance of the student actually arriving. The student gets to secure their place in an apartment complex. Everybody wins. I think it's some interesting concepts that has not been implemented yet, to my knowledge, but I think it probably should be and probably will be at some point. I do have another colleague who just announced last week, they've created a token, and I can't tell for sure if this is a utility token. It's more of a money token. It tracks their real estate portfolio. So as their real estate portfolio value goes up, they either issue more tokens or the value of the tokens go up to match the value of the portfolio.
So it's like an ETF, basically, right?
Except that they don't actually have ownership in the portfolio. So I'm not completely sure I understand it. It tracks the value of something, but it's not backed by the something. And so I need to have a longer discussion with him. That's called HGH token, which is really interesting. They're very good syndicators. Security tokens have a huge place in real estate. So the group that I come with, and I've done real estate syndication myself. The idea is that you are going to pool a bunch of investors' money to buy a larger, nicer property. And that is a really common thing to do in the US and all around the world. But when you do that, pretty much everybody tells you that's a security because you have an investment of money in a common enterprise with an expectation of profit due solely or primarily to the third parties who are actually running the property. So that's called the Howey test, and that's a way you know if something is a security in the United States. And that applies largely in most places as well. I think that's been kind of the test for an investment contract almost everywhere. Well, if you do pool investors' funds, you're creating a security. Well, that's okay. Issue a security token. You still follow all the securities laws. And in fact, cryptocurrency should be welcomed by all of the securities regulators all around the world, because these security tokens can have embedded in their smart contracts automated enforcement of the securities laws. So they can enforce that you can't sell them to an unqualified person from any particular country based on those countries' laws. So I would think that the securities regulators would actually welcome these. But what's happening right now is that property tokenizers, if you want to do a syndication and you want to put investors together, the usual way you do that in real estate is you get the investors together, you do something called a private placement memorandum. And you would do this for a company too, if you're trying to raise funds. And then you have an LLC or some sort of company that actually owns the assets. And then the investors have partial ownership of the LLC. And today they get little paper certificates that say, yeah, I'm an ownership of an LLC. And that's all perfectly fine. But if instead of giving them paper certificates, you gave them a quantity of crypto tokens that represented that ownership in the LLC, now you have a security token offering. You still have your PPM. You're still following all the securities laws, which you should. And your investors here. But the big difference, and here's the huge difference between doing this as what we call a property tokenization instead of a syndication. The SEC says that after an appropriate holding period, your investors are allowed to sell their ownership interest on a secondary market, provided the operating agreement of the LLC allows for it. But there's no secondary market with syndications. Everybody's doing this all on their own. There's no real place to go to buy ownership shares. If those are cryptocurrency tokens, it is a very natural thing to be able to have a secondary market where those investors can now go sell their shares. So you can give investors liquidity. For a typical, say, an apartment complex syndication, you're going to raise $10, $20 million. Those investors usually have their funds tied up for 3, 5, 7, even 10 years. They can't get their money back. Now, they might get their money back if you refinance. They do get your money back if you sell the overall property. But that's a long time to have your money out. If instead you have these tokens now, after roughly a year, if an investor wants to sell a little bit of their ownership, they could go sell a little bit of their ownership. If they want to buy more of the ownership, they could buy more of the ownership. You have this nice liquidity. And so that liquidity is absolutely huge. It would be transformational for real estate. And because you also have liquidity, current real estate pricing, what's the market value of an apartment complex? Well, the fact that it takes some time to sell that apartment complex is baked into the price. So when you remove the illiquidity penalty on real estate, now you have liquid assets. The value of that real estate can go up because it's more liquid. Just as for cryptocurrency tokens, ones that are more liquid, the values tend to go up as well. So the estimates that I've seen range from a 10% to a 30% premium. So you could increase the value of your real estate by tokenizing it this way and making it more liquid. So those are huge incentives. And I find it difficult to find any real downside to doing a property tokenization. I've been looking for one. I guess people are unfamiliar with cryptocurrency and they have to be a little careful how it's held, but you could always have a custodian hold your cryptocurrency. And since you have to do KYC, know your customer, and anti-money laundering checks for any security sales, you know who your investors are. So if they were hacked, you could always burn those tokens and replace them because you know who your investor is. So you don't really have the hacking issue with property tokenization either. I don't know why anybody wouldn't do that. In fact, I'm working with a couple of groups who are planning to do property tokenization with the idea of building this huge secondary market. Now, there's restrictions on how you do a secondary market too with securities laws, but those can be worked with. And there are some really good exchanges out there like T0 that allow you to sell securities tokens. So you can get things listed on there.
Yeah, I think your definition has helped our listeners a lot to understand the security token perspective and how it's useful for there. But I'm sure it's like all cryptocurrencies are giving a SEC a headache to decide what's a utility token and what's a security token. It's like debates for hours, right? We cannot really put lines there. But there is one fine detail I want to enlighten with you more, because currently you mentioned as a utility token like the frequent flyer miles, right? But frequent flyer miles are really constant in value. So you get, for example, a ticket for 8,000 miles, etc. But in the cryptocurrency world, utility tokens also fluctuate in value. So that's a little bit different to what we are used to as the utility token before the cryptocurrency world. How do you see these utility tokens in the real estate world? Are they going to be stable in value and directly exchanged with goods? Or are they also going to have a value that's fluctuating in the market and being sold and bought?
That's a really good question. But the first thing I'll say is I'm not sure I think that the frequent flyer miles are fixed in value, because the airlines can, at a whim, change how many miles it takes to buy a flight. So its purchasing power can change. But but I think you've hit on a really important point, and that is, what is the value of a utility token? Because the utility token is used for goods or services within your company. And so you're more or less setting the value of that utility token by how many tokens it requires for each service. So one of the things that I think you could and maybe should do in order to make those tokens attractive to people is to fix the purchasing power of the utility tokens. So let's say, for example, you have an apartment complex and you accept security tokens for rent. Okay, and rent is $1,000 a month. I'll use US units. I'm sorry, I'm in the US. That's what I tend to default to. Rent is $1,000 a month right now, and you're issuing 1,000 security tokens at about roughly $1 each. 1,000 security tokens will buy you a month's rent. Well, let's say, okay, now I'm going to fix forever that the utility tokens, 1,000 utility tokens will buy a month's rent. And then next year, the rents have gone up 20%, which is kind of what's happening in the US right now. And so now my rent would cost me $1,200, but it still costs me 1,000 utility tokens. So now if you do that math, your utility token's worth $1.20 if you were to buy it with dollars, but it's still worth 1/1,000th of a month rent. So the real question here is purchasing power versus dollar value versus, utility coin value. So your utility token, you don't have to fix it so that it's always 1,000. You could say, okay, now you need 1,200 utility tokens to pay the rent. And so you could have your utility token act like a stable coin against the dollar, or you could have it act like a stable coin against the purchasing power. And I think those are the two main options that people would choose. And you could do them for different reasons. But I think it's a really interesting idea to have the utility have a common purchase power so that dollars become irrelevant. Then people might want to stock up on utility tokens, effectively prepaying rent in the future so that they can fix their rent for a longer time. So I think there's some really interesting dynamics that could happen with all that.
I really having hard time understanding why would anyone want to have a stable coin unless you have, I don't know, really a really good use cases. But in this case, it can really work because it's real estate, and I want to go into this investment property, like stay there or like rent there for, let's say, 10,000 coin, 1,000 token worth of $1,000. right? Next year, I would want to again like rent it for like 1,000 or 1,100. I think like there can be a good use in stable coins in this case. What do you think about?
Well, I think it depends on what you mean by stable. I've always laughed at the idea of a token tied to the value of the US dollar as a stable coin when the dollar is losing value all the time. So a question what you mean by stable. Usually what you mean is that it's tied to the value of something else. So if USDC is tied to the value of a dollar, it's always worth $1. I don't know that people would ever want to hold those because you're guaranteed to lose money. Just like if you hold dollars, you're guaranteed to lose money. But for short-term settlements, you can move stable coins around in ways that you might not be able to move dollars around, because there's all this KYC and AML, but once you have stable coins, you can move those to a decentralized exchange. You can move them around to whatever you want. So for short-term settlements, they're easier to move around, I think, than dollars. And that's kind of why you want them. That's what I've seen them used for most effectively, is as settlement tokens, where they go in between one thing and another. I'm not really sure on the utility token side. I kind of like the idea of fixing purchasing power, because I think of what can you buy with it, and that seems to be more stable to me than anything else. And that's why some of the tokens that are pegged, say, to gold, where they actually are backed by gold, I think of those more like stable coins, because their purchasing power is likely to remain constant while the price of gold goes up. So the value in dollars will go up, but the purchasing power will stay the same. And I think we really have to look at purchasing power and dollar value as completely different things, because they're diverging so dramatically, especially in today's climate.
Yeah, actually, we really mentioned tokens a lot, so I want to also discuss other things that's exciting. So I want to shift you away a little bit from the tokens by making a connection, actually, because in your book you also make this connection with the traditional real estate investing and the fractional stance that you can divide it into pieces, and how you can do this with cryptocurrencies. And when you talk about it there, you specifically mention like the security token offerings versus real estate investment trusts. So when you compare these like fractional ownings in the real estate investment landscape, how do you compare these to the traditional fractional ownership of real estate and modern cryptocurrency based fractional ownership through a security token?
Sure. Well, as you point out, that there's really two ways of doing fractional ownership that are in common use. One is with a real estate investment trust, or a REIT, and the other is with a syndication or a private placement, which is usually not a public offering. REITs are public. So the difference is that a REIT usually owns a lot of properties. And so what you own is a part of a fund of real estate and not an individual property. And that has benefits, it has disadvantages, right? Certainly you have the ability to have a diversification among what you own among multiple properties. But diversification almost always dilutes return as well, because you're putting in bad properties with good properties. So if you're okay at doing due diligence in the properties and you can understand how well a property is doing, then you might be better off purchasing the one good property instead of purchasing a bag of properties which has some really good ones and some really bad ones. REITs also tend to have a lot more fees associated with them. And of course, they're traded publicly. So, the liquidity is really good in a REIT, which it's not in a syndication. There's back and forth there, but there's no reason why you couldn't do a REIT and issue the shares in the REIT as a cryptocurrency. So you absolutely could do a REIT. And in fact, I know of a guy, Michael Flight, who's his is still a private placement. He does Liberty Coin. And his idea is to take a whole real estate fund and to tokenize that. And Michael's really sharp and very good at doing what he's doing there. So, you know, I'll call him out. Maybe give me another guest on your podcast. But
I would love
okay.
that. Like, yeah, that would be great. Michael Flight, you are our next guest. Thank you.
but you know, so you can tokenize a fund for real estate. You can tokenize a property. You could tokenize a portfolio. But and now there's even people who are tokenizing individual rental properties. 3-4 years ago, to do any sort of property tokenization was going to cost you $50,000 to $75,000 to $120,000. So you really couldn't afford to do that on a $50,000 property. You just couldn't do it. You had to do a $10 million property to make it worth your while. But now there are folks who have figured out some ways of doing serial tokenization. And you know, it may be too technical to go into on a podcast like this, but they can do tokenizations for individual properties for themselves pretty inexpensively. So they can issue a new property a week. And Lofty.ai does that. And I think Realty does that, Real Tokens. And I think there's a couple of others that are looking into it. There's one group that's asked me to help support them. Putting that out there, but again, they haven't launched yet, so I won't go into that. But this kind of approach, it democratizes the properties. It does, I think, create some challenges. When you typically have a syndication, you could potentially have an capital call. So if the roof caves in and you didn't have enough insurance and you need money to fix things, or you have something else going on, you make a call out to the partners for additional capital. You're not going to be able to do that with cryptocurrency. You have to make absolutely certain that there's enough money in the project to be able to pay all the project's expenses. Now, you can distribute cash flow to investors, which is, by the way, a way for cryptocurrency investors to get cash flow, which is not very common. But you really can't have cash coming in from investors, especially when you have, you know, maybe 1,000 investors in your project after the sales go on for a while. So I'm kind of rambling here a little bit, but you have to be very careful with small rental properties because they are very subject to having, say, needing a new roof, or the air conditioner goes out and you have to replace it. You have to make sure among your overall portfolio that you're able to handle those sorts of issues without having to go to investors.
If you happen to give an example for this case, there's Grant Cardone has a Cardone Capital. Accredited investors can go in there, put their money, Cardone Capital, do the investment, and it works like a syndication, right? You say that we can transform it to a crypto investment, issue a security token, bring on more and more people, even non-accredited investors, like individual investors can buy it from secondary markets. You can create a really big amount of liquidity like REITs, and you can have it, I want to say rather quickly, but more effectively, right? So that's fascinating. That sounds really too good to be true. Is it?
There are always upsides and downsides to any investment.
Mm-hmm.
Okay, there are risks, there are rewards. There are risks with cryptocurrency. There's risks with real estate. They're different risks, and that's part of why I really like putting them together, because your risk in cryptocurrency is volatility. You have potential of really losing your capital. Real estate has a lot of ways of managing risks, but between insurance and having additional contingency funds, and really the government protects you in many, many ways. Being able to leverage gets you some strong insurance as well with real estate. So there's a lot of things that you can do to mitigate your risks in real estate. There are things you can do to mitigate your risks in cryptocurrency, but they're different. So if you invest in Grant Cardone's fund, which I don't know that much about that specific one, but
he's just famous.
Well, they have a lot of experience. They're very good at real estate. They know what they're doing. So that expertise really helps you a lot to have confidence that they're going to perform very well. And there are guys who have done syndication after syndication after syndication, and they have very strong, repeatable performance that's very, very good. So you're going to do well if you invest with people like that. Even when there are problems, they have multiple exit strategies. They have different ways of getting funding or leveraging. If you've got long-term loans at like 2.5% interest, and the currency itself is devaluing 15% per year, you end up paying back really less in purchasing power than what you paid for the property. So there's just so many good things you can do with real estate. Excuse me. On the crypto side, you're starting to get some of those things as well. So I'm not sure I see that much of leverage in terms of buying cryptocurrency, but you do have staking where you can get interest. You have ways of getting loans secured by cryptocurrency, which you didn't have before. So you can do that. And that's one of the things I advocate, is getting a loan secured by your cryptocurrency with all that appreciation, and then go buy real estate with that. So now you don't have a taxable event, you don't have a capital gain, you haven't sold your cryptocurrency, you get to add to your portfolio, and you can turn that cryptocurrency into cash flow. So some really good things that you can do there. I think I've rambled a little bit from your question, but
I think you took the topic to a very good point, because that's what I was gonna ask next. You said loaning like with the amount to buy a real estate. You mainly mentioned like 4 strategies in your book. One of them was the loan against cryptocurrencies, another one's cross-collateralization, another one is lending cryptocurrency, actually, very unorthodox, and qualifying for a loan was the 4th one. Of course, if we dig deep into each of these, I'm sure we are going to be here for another hour. That's why I want to ask you, what method is your favorite actually, and if you are just a simple investor who wants to buy a house, not very sophisticated instruments, you just buy a nice house, which instrument here, which method here you would prefer to go with?
So my favorite and the simple investor's favorite probably aren't the same. But if you're a simple investor, you want to buy a house and you have crypto assets. If you sell those crypto assets to buy the house, you're going to have a big capital gains hit. So you're going to have to sell a lot more crypto than you would like to buy that house. In that case, I like the idea of borrowing against your cryptocurrency, using that as a down payment for the house, and then getting a regular loan against the house, which you can get all day long. So essentially, you buy that house with no actual money coming out of your pocket from your income. You're essentially using money from your crypto and money that's secured by the house, and then you've bought the house. So if I were the simple investor and I had cryptocurrency that had appreciated and that you could get loans against, because there's maybe a double handful of cryptocurrencies that you can actually get loans secured against. That's probably what I would do. For me, I really like the idea of cross-collateralization. So I like the idea of adding cryptocurrency to the value of the real estate. So let's say that I have a $10 million apartment complex, and I can get, these days, let's say it's a 70% loan against the apartment complex. In better climates, it might be 80% or even 90%, but let's say it's a 70% loan against the apartment complex. And then I take, say, 6 million of cryptocurrency and get a 50% loan against the cryptocurrency of 3 million. So I've got 3 million from my cryptocurrency and 7 million from the apartment complex loan, and now I bought it with no actual money out of my pocket. That one really attracts me. But I like the idea as well of adding real estate as collateral for cryptocurrency. So let's suppose you have a cryptocurrency like my Troptions that is not really easy to liquidate. And so a lender is not going to look very favorably on that right away. But I'll say, okay, look, I will give you 10% LTV or 25% LTV for the Troptions, and I'm going to go buy real estate with that money, and I'll add the real estate as collateral. So now the lender's 100% secured by real estate and like 1,000% secured by crypto. So they're very, very, very well secured. And so, especially if you have a good amount of crypto, that kind of cross collateralization is really of interest. The other thing I've seen, and this is one trick one of my mentors, Bob Steele, has talked about, and he was the creator of RexNet. He likes to do loans that are part cryptocurrency and part real estate, or part cryptocurrency and part cash. So let's say that somebody wants $120,000 loan. You're going to give them a $150,000 loan, $120,000 in cash and $30,000 in cryptocurrency, and they're going to pay you back $150,000 in cash. There's a lot of cases where that makes really good sense. If this person has a fabulous deal, they can come in, they can do that all day, and it gets the money they wouldn't otherwise get. So there's another interesting approach for doing loans to go buy real estate. That's a combination of cash and cryptocurrency.
How does it work for landowners? How do you like make them like take cryptocurrency as like payments for the property? I believe like we still need banks if we are going to pay half cash, half crypto. So and like that cash also comes from the loan. So there should be a like bank involvement. So like how do we make them get into this like crypto loaning against crypto, both like landowners perspective and also like the bank's perspective?
So yeah, you're right. Today it's very challenging to get a bank to look at loaning money when cryptocurrency is involved. Banks are very, very conservative, and they're very highly regulated. And so that's part of why they're very, very conservative. But there's a huge lending market that has nothing to do with banks. It's private lending, hard money lending. Hard money usually means higher interest rates. Not that the money's like any more solid than anything else, but there's a huge private lending market of billions, maybe even trillions of dollars out there. And that is money of private people trying to make loans themselves because they don't want to own the property. If they're debt, they just get a regular, steady return. And that's one way of investing in real estate. And so private lenders are far more likely to consider a loan where cryptocurrency is involved. And the loan I just described a minute ago, where it's part crypto and part cash, that's a private lender making that loan to a borrower. So I think you're going to be in the private market until regulations really come out and are settled down so that banks have something they can rely on when they get audited that says this loan was a good loan. When I've talked with banks, I was looking for banks where I didn't want the bank to accept any cryptocurrency. I just wanted to buy by the seller cryptocurrency and have the bank do a loan against the rest. And even in those cases, banks would say, well, how do I know what the value of the cryptocurrency is? I said, here's the website. They're like, well, I don't know if that's really real or that's really true. Maybe cryptocurrency is worth nothing. That's what banks are saying. And so then I would go to them, well, we're doing an appraisal. So you don't really have to care what the value of the asset I'm providing the seller is. The appraisal tells you what the value of the property is. And all you really need to know is, are you well secured? And that should be the right answer. But I think banks are as skeptical of appraisers as I am. And so they tend to think that appraisers will come in with whatever value the purchase price is, unless they find a reason they can't do that. So banks have been an issue. I just don't see that banks are going to come out there. Now, there's new digital banks that are coming out that are explicitly crypto friendly. Caitlin Long out of Wyoming is doing, I think it's Avanti Bank. And then there's Prime Trust, which is, I believe, a registered bank online. And as those institutions become bigger and more prominent and they get their presence solidified and accepted, I think you'll find other banks are able to do it as well.
Got it. Before we wrap this up, I learned tons of things, but like, let's talk about also investment objectives. We always talk about also in this podcast that you have to have a goal, like unless you want to like end up like I don't know, some rabbit hole. You mentioned in the book there are different goals, like income goals, like passive income, like Robert Kiyosaki says. How do you approach to this, like in your perspective?
Well, it always has to be an individually tailored approach.
Mm-hmm.
It will depend on whether the investor is young or old. It will depend on whether the investor is willing to take risks or not willing to take risks. It will depend on whether the investor needs income from the investments or whether they can just let them go off and grow somewhere. There's a lot of different things that factor into what you ought to do. And so giving a one-size-fits-all is just not right. But if the investor can sit down and say, okay, look, I need my investments to provide me with this much cash flow. I'm looking to grow my portfolio to this value. I need tax incentives. I need tax benefits. So, you don't get any tax benefits from cryptocurrency, but depreciation is a huge benefit, especially in the US, to take money off of your taxes. It's sort of a phantom loss that allows you to reduce your taxes really substantially if you have a sizable real estate portfolio. So you need to look at how much money am I trying to make, how much am I trying to keep, and am I trying to build a portfolio? And then how much do I want in terms of diversification? Because you can manage the risk of achieving your objectives by having different types of assets that have different risks. And so it's really hard to give you a single answer. You want cash flow? Real estate's great. Cryptocurrency, not so much. You want appreciation? Cryptocurrency beats anything else in history. You want tax advantages? You need to reduce your taxes. You need to increase how much you keep from how much you make. Again, real estate is probably going to be a huge help. And real estate like multifamily is absolutely fabulous for that, whereas land is not. So you really need someone who can help you work through those objectives. And that can be a financial planner, but really a real estate broker who understands real estate exchange is used to talking with clients about exactly those sorts of objectives. What is it you're trying to accomplish? If you're trying to sell a piece of real estate, what is it you want from that? What are you going to do with the money? What do you need? What would be a good outcome for you? And understanding those things really helps you decide where to go next. If you're a cryptocurrency guy and all of a sudden, hey, I got in early on a couple of different tokens and now they've gone to the moon, that's great. It's bragging rights, but you have issues. You got huge capital gains issues if you try to sell. You have potential volatility issues because what goes up can come down. So you need to be able to address those sorts of issues if you're a cryptocurrency investor. And real estate may be a very good place to put some of those assets that would be a good hedge for you. So I hate to give you this kind of indeterminate answer, but if you're looking for cash flow, real estate. If you're looking for tax advantages, real estate. If you're looking for appreciation, cryptocurrency. And I think you really ought to have some of all of it. And even among cryptocurrency, the quote unquote blue chips like Bitcoin and Ethereum might be part of your portfolio. But if you want that huge appreciation for future, you may be looking at some startups, some brand new cryptocurrencies. And how you would allocate among that depends a little bit on your objectives and your tolerances and your skills. So I couldn't give you a straight answer on that. I'm sorry.
I think, Steve, like we are into like 1 hour right now into our talk, and you gave so many valuable lessons for everyone. It was definitely an absolute delight to have you as a guest in this show. People learned a lot. When I first reading the book, I had the impression that you wrote the book for real estate investors to convince them that here, look at the guys, there is a value in the cryptocurrency side. You joined our show to an audience that's mainly cryptocurrency investment background, and they learned tons about the real estate investing. So I think it was a great cross-platform, let's say, knowledge exchange, and it was brilliant. Thanks a lot for everything you brought to the table today.
Well, and maybe in the future, we can have a discussion on real estate title on the blockchain and NFTs and how they can be used.
Definitely. And I'm sure that like you already share some information, maybe through social media, maybe from somewhere. Can you just tell our listeners when they can find you, your work, and get more out of this wisdom?
Well, if you want a one-stop shop, the best place to go is cryptorebook.com. You can find the book there. You can find a course there, which I have on selling your real estate for cryptocurrency. And you have access to my email and contact information on that website as well. So feel free to go to that website and reach out to me. I'm happy to help people just in general, because I think there's a lot of navigation that needs to happen in this environment. And you know, I do consult. I try to help people with particular projects if they're trying to do things. So reach out. Let's make something happen.
Perfect.
Great stuff. And thanks for joining our podcast, and see you on the next episode, I believe.
Okay. Thank you all very much. I appreciate it.
All right.
Thank you.
Cheers.
Take care, everyone. See you in the next episode. Bye-bye.